Welcome to today's deep dive. I mean, imagine buying a used car without ever actually popping the hood.
Oh, yeah. Never a good idea.
Right. You just walk onto the lot, look at this really shiny paint job,
Hmm.
glance at the sticker price on the windshield, hand over your life savings, and just drive off.
Completely reckless.
Sounds insane. You wouldn't do it. But, millions of people do exactly this every single day in the stock market. They see a ticker symbol going up on a screen, they feel the hype, and they just buy in without the slightest idea of what is actually powering the machine.
Yeah, they're basically just buying the sticker price. They're completely blind to the vehicle history report. And that discrepancy, like the massive gap between what something is currently selling for and what it's, fundamentally worth,
Hmm.
that is where fortunes are quietly made and lost.
Exactly. Okay, let's unpack this. Because today's source material is a really comprehensive guide on fundamental analysis theory and practice. And the whole mission for this deep dive is to demystify how investors calculate that true intrinsic value, how to look past the flashy marketing and find the hard
Right,
facts.
and to really get what fundamental analysis is, we kind of have to look at what it's reacting against. You have this massive school of thought out there called technical analysis.
Right, the chart readers.
Exactly. If fundamental analysis is popping the hood to check the transmission, technical analysis is, well, it's completely ignoring the car and just staring at the crowd of people standing around the dealership.
Just to see how excited they are.
Yeah, it's pure behavioral observation. What's fascinating here is the philosophical divide regarding where value even comes from. Technical analysts, they're looking at historical market data, momentum, trading volumes. They're mapping out these complex chart patterns with names like head and shoulders.
Which always sounds like shampoo to me, but go on.
Right. But they use it to predict short-term price movements over just days or weeks. They honestly don't care if a company makes microchips or, like, potato chips.
As long as the line goes up.
Exactly. If the stock chart has the right momentum, they're in. For them, the market price literally is the value. If someone is willing to pay $100 a share right this second, it's worth $100.
Wait, let me stop you right there because I really have to push back on that.
Sure.
If the market literally dictates the price you pay to buy in and the price you get when you cash out, isn't that the actual value? I mean, why do fundamental analysts think they somehow know better than the collective wisdom of millions of buyers and sellers and, supercomputers trading every second?
Well, because fundamental analysts don't actually believe the market is perfectly wise.
They think it's wrong?
Often, yes.
Yeah.
They believe the market is highly emotional and incredibly short-sighted. I mean, look at the time horizons. The
Yeah.
market is driven by quarterly panic, fear, greed, euphoria.
Just reacting to whatever the news cycle is that day.
Precisely. And those emotions cause the market price to completely detach from reality and swing wildly. So over a period of weeks, stock prices are just a popularity contest. But over a period of 5 or 10 years, fundamentals drive reality.
The actual business matters eventually.
A company generating massive compounding cash flows will eventually force the market to recognize its value. So the goal of the fundamental investor is to buy the stock when the market is acting out of, unwarranted panic and just hold it until the crowd eventually sobers up.
Okay, so if you're looking at a company and you suspect the market has it priced completely wrong, where do you actually go to prove it? I mean, we're moving from the philosophy to the actual treasure map here.
You go straight to the raw data. For public companies, you completely bypass the flashy press releases and go straight to the SEC's EDJR database.
Which is public, right? Anyone can use it.
Yep, completely free. You are looking for the legally mandated filings, the 10K, which is the massive, exhaustive annual report,
Yeah.
the 10Q, which is the quarterly update, and the 8K,
Remind me, the AK is the emergency one.
basically. Companies have to fire off an 8K when a major material event happens, like a key executive suddenly resigning or a major acquisition.
Okay, but anyone can go to a company's investor relations website and pull up a 10K. The text mentions reading the CEO's letter to shareholders to gauge the tone and looking at the management's discussion and analysis section. But let's elevate this.
Okay.
How does a professional analyst actually exploit this information? Because it's not just about reading it like a novel on a Sunday afternoon.
No, not at all. It's about looking for the subtle shifts. Hedge funds and professional analysts don't just read this year's 10K. They use software to run a differential analysis between last year's 10K and this year.
Oh, like a document compare?
Exactly. And they're specifically looking at the risk factors section because management teams are notoriously repetitive. They just copy-paste boilerplate language for 5 years straight.
So if they change something
Exactly. If they suddenly insert one new sentence about, say, supply chain vulnerabilities in Southeast Asia, that is a massive red flag. The software spots it, the analyst flags it, and suddenly they know something the average retail investor just totally missed.
Or they listen to the earnings call transcripts. Our sources highlighted this specifically because the prepared remarks from the CEO at the beginning, that's just corporate theater.
Oh, 100%. It's totally scripted.
But the Q&A section at the end where the Wall Street analysts actually grill the management team on their soft spots, that's where you hear the real story.
Yeah, that's where you hear a CFO stumble or dodge a direct question about declining margins.
And you combine that with the independent auditor's report,
Yeah.
right? The one attached to the financials.
Yes, that is crucial. If the outside accounting firm says they have going concern doubts or they have reservations about how the books are kept, you just walk away. I mean, the numbers mean absolutely nothing if the auditor doesn't even trust them.
But the numbers aren't everything anyway. The sources spend a huge amount of time on qualitative fundamentals, the intangibles.
Right, the stuff you can't easily put in a spreadsheet.
Yeah, things like brand recognition, corporate governance, ESG targets, and they use this really great term, the economic moat.
I love that term.
Right. The competitive advantage that keeps rival armies away from your castle.
And the examples the text provides are perfect illustrations of moats. Like, Coca-Cola's brand name is basically an impenetrable moat.
Because everyone knows it.
Exactly. Someone else could arguably formulate a much better tasting soda tomorrow, but they can't replicate a century of global psychological conditioning. Or look at Microsoft's historical domination of the PC operating system.
Oh, right, the switching costs.
Yeah, the cost for a massive enterprise to retrain everyone and leave Microsoft is so astronomically high, it just creates a massive structural moat.
Which brings us to the actual business model inside that castle. The text gave this wild example of evaluating a fast food chicken company. And on the surface, you just assume they make their money by buying raw chicken, frying it, and selling it at a markup.
Naturally. But qualitative analysis forces you to ask,
Yeah.
wait, who actually owns the fryers?
Exactly. Like, are they an operating company dealing with fluctuating poultry prices and minimum wage labor disputes and real estate costs? Or are they entirely franchised?
And if they are franchised.
Then they're just collecting a guaranteed, say, 5% royalty fee on the gross sales of thousands of franchisees. They aren't really in the chicken business at all. They're in the intellectual property and real estate business.
Which is a fundamentally different risk profile
Mhm.
and a completely different margin structure. If we connect this to the bigger picture, reading these qualitative clues tells you if the leadership is actually capable of executing their specific business model.
So you look at the people in charge.
Right. You have to look at the board of directors. Are they fiercely independent, or are they just a rubber stamp committee of the CEO's college buddies? You also have to look at insider trading.
Oh, yeah. Following the money.
Always. If the CEO is on an earnings call projecting record growth, but then you look at the SEC filings and see they've quietly liquidated 80% of their personal stock over the last 3 months.
Wow, yeah.
Their actions are screaming the truth while their words are just lying to you.
But even a visionary CEO with a massive brand moat can't hide a bleeding balance sheet forever, right?
No, they can't.
At a certain point, the good vibes have to translate into actual math. The qualitative story has to be backed up by quantitative proof.
And this is where we dive into the hard numbers.
Okay.
The 3 major financial statements. Now, I know you understand the basics of revenue and profit, but let's look at how analysts actually tear these documents apart. You have the income statement, the balance sheet, and the statement of cash flows.
No, the sources basically put a giant neon sign pointing at the statement of cash flows. They treat it like it's the holy grail of financial truth. Why is it so vastly superior to the income statement?
Because the income statement is subject to GAAP.
Generally accepted accounting principles.
Exactly. And GAAP allows for immense flexibility and, frankly, perfectly legal manipulation. Like, let's say a company buys a massive $10 million piece of factory equipment. Under GAAP accounting, they don't have to report a $10 million loss on the income statement today.
Oh, they depreciate it.
Yes. They can capitalize that expense and spread it out over 20 years. So on the income statement, it looks like they only spent $500,000 this year. Their profit looks fantastic.
But their actual bank account is still $10 million lighter in reality.
Exactly. The income statement is this heavily manicured narrative of profitability. But the cash flow statement, that is brutal reality.
No hiding there.
None. It strips away all those non-cash accounting adjustments and shows you exactly how much raw cash actually entered the building and how much left. It is incredibly tough to fake cash in the bank.
Mm.
Conservative investors worship the cash flow statement because it tells you if the core operations are actually throwing off enough cash to survive, or if the company's just keeping the lights on by constantly borrowing more money.
Cash is undeniable. Okay, let's pivot to the balance sheet, because the text highlighted a specific formula. It notes that a balance sheet is a snapshot of assets, liabilities, and shareholders' equity. And it gets its name because it must balance. Assets equal liabilities plus shareholders' equity.
Right, that's the core rule.
Okay, here's where it gets really interesting, because if this thing has to balance by a strict mathematical formula, doesn't that make it an artificial snapshot? Like, you aren't really measuring the raw, real-time health of the company. You're just forcing an equation to zero out.
It feels artificial until you look at the mechanism behind it. The balancing act isn't some accounting parlor trick. It's the fundamental genius of double-entry accounting.
How so?
Think of it like buying a house. If you buy a $500,000 house, that is your asset. But how did you pay for it? Well, you took out a $400,000 mortgage, which is your liability, and you put down a $100,000 down payment, your equity. So the $500,000 asset perfectly equals the $400,000 liability plus the $100,000 equity.
Ah. So the formula isn't hiding the reality, it's forcing the company to identify the exact source of every single dollar of value they claim to have.
Precisely. If a company boasts about having $10 billion in assets, the balancing formula forces them to show you whether they own those assets free and clear through equity, or if they're just drowning in $10 billion of high-interest debt to maintain the illusion of wealth.
That makes total sense. So from these three statements, the analysts extract the data to calculate the key financial ratios. And this is where we actually get to the valuation, figuring out if that sticker price makes sense. The sources list several, like the current ratio, which measures near-term liquidity, like can you pay your bills over the next 12 months, or are you going bankrupt?
Yeah, the current ratio is your basic survival metric. But the granddaddy of valuation is the PE ratio, price to earnings. You just take the current market price per share and divide it by the earnings per share.
And the text mentions a low PE means undervalued, a high PE means overvalued. But mechanically, why is that? What is that number actually telling you in the real world?
Think of the PE ratio as a payback period. Let's say a stock is trading at $100 a share, and the company earns $1 per share in profit. The PE ratio is 100.
Okay.
That means you are paying $100 for every $1 of current earnings. In a static world, it would literally take you a century to earn your money back.
Wow. Which means if you are buying a stock with a PE of 100, you're making a massive, aggressive bet that their profits are going to completely explode in the near future.
You have to be, because if they don't, you are left holding the bag. Conversely, a PE of 8 means you're paying $8 for a dollar of profit. Value investors hunt for those low PE ratios, hoping to find a fundamentally sound company that the market has just completely ignored.
Okay, so we've got the SEC filings. We know how to strip away the accounting tricks using the cash flow statement, and we have the formulas to find the undervalued gems. It sounds like a foolproof mathematical cheat code to infinite wealth. So why isn't every fundamental analyst just chilling on a yacht right now?
Well, which brings us to the blind spots. The system has massive, glaring limitations. First of all, doing this correctly is a grueling, heavily time-intensive process. You are combing through hundreds of pages of dense legal filings, building models, projecting cash flow.
And while you're doing all that math.
By the time you finally find your hidden gem, a hedge fund with a supercomputer might have already bought in and closed the pricing gap.
Plus, the sources emphasize how heavily this relies on macroeconomic assumptions. Like, you can build a flawless financial model for a real estate company based on today's interest rates.
Oh, absolutely.
Then tomorrow, the Federal Reserve unexpectedly jacks up rates by a full percent, the cost of borrowing skyrockets, and your perfectly calculated intrinsic value is instantly garbage.
Yeah. This raises an important question about the whole method. It leads to the biggest structural flaw. Fundamental analysis is inherently a lagging indicator. You are constantly looking backward.
Right. It's like driving a car by only looking in the rearview mirror. You know exactly where you've been and how much gas you used, but you might still hit a massive pothole right in front of you.
That is a perfect analogy. And honestly, I'd argue it's even worse than that. It's more like looking at the light from a distant star.
Oh, because of the time delay.
Exactly. You aren't seeing the star as it is right now. You are seeing the light it emitted a year ago. A 10K report captures a financial reality that ended on, say, December 31st. By the time it gets audited, filed, and you finally read it in late February, the entire global landscape could have completely shifted. The star might have already exploded.
And even if you get the data quickly, those gap accounting rules we talked about earlier can still obscure the future. I mean, management makes estimates all the time. They estimate how many customers will default on their loans. They estimate the useful life of their factory equipment.
Right. And if their estimates are aggressively optimistic, the historical math looks beautiful. But the future reality is a cliff.
And there are some things math simply cannot measure. The sources explicitly highlight the ultimate limitation of fundamental analysis, the sheer difficulty of valuing intangibles.
The Steve Jobs example from the text is the perfect encapsulation of this.
Yeah, I loved that part.
Right. Traditional fundamental analysis completely failed to price in the value of Steve Jobs returning to Apple. If you just ran the spreadsheets and looked at the PE ratios and the massive R&D burn rate during the development of the iPod and the iPhone.
Traditional metrics might have told you to sell.
Exactly. Because there is no line item on a balance sheet for once-in-a-generation visionary. The fundamentals demanded a discount, but his vision demanded a massive premium. That is why relying strictly on historical math can make you miss the biggest wealth creation events in history.
So modern investors don't just use this in a vacuum. The sources describe a blended approach. They use fundamental analysis to figure out what the company is theoretically worth over the next decade, but then they might use technical analysis, reading the market momentum to time exactly when they actually buy the stock.
Yeah, they blend the historical math with forward-looking industry analysis. The text gave a hypothetical example of a company called ABC Inc.
Right, the growth example.
Yeah, it wasn't enough that ABC had a strong balance sheet today. Investors also needed to know that ABC was operating in an expanding market, had a pipeline of disruptive new products launching in 18 months, and was aligning with evolving ESG standards that future consumers would demand. You just have to marry the quantitative past with the qualitative future.
Man, we've covered an immense amount of ground here. From the philosophical debate over what actually creates value, down into the weeds of the SEC filings and capitalizing expenses, all the way to realizing that even perfect math has a blind spot for human genius.
It's a lot to take in.
It is. And whether you prefer a top-down approach, where you analyze the global economy first and zoom down to a specific stock, or a bottom-up approach, where you find a company with a great PE ratio and zoom out, the objective remains the same.
Cutting through the noise.
Exactly. So what does this all mean? If you're listening to this, how do you actually apply this? Because you probably aren't managing a multi-billion-dollar hedge fund or running differential software on risk disclosures.
Probably not.
But adopting this critical fundamental mindset is incredibly powerful. We live in an era of pure information overload. Viral trends, algorithmic hype, companies skyrocketing in value based on a single tweet. The ability to pause, ignore the shiny sticker price, and ask, wait, where is the cash actually coming from, is just a critical life skill.
It really is.
It applies to evaluating a stock, assessing a job offer at a startup, or making any major financial commitment. It's the discipline of always looking under the hood.
It's basically intellectual self-defense. But, building on that Steve Jobs example from earlier, I want to leave you with one final thought to explore on your own.
Okay, let's hear it.
If our modern economy is rapidly shifting away from tangible factories and physical inventory, and it's increasingly driven by pure intangibles like proprietary AI algorithms, viral brand loyalty, or the sheer cult of personality around a founder, is traditional fundamental analysis, with its heavy reliance on past financial statements, destined to become obsolete.
Oh, wow.
Yeah. If the most valuable assets in the world no longer fit on a standard balance sheet, will we eventually have to invent an entirely new type of math just to measure human behavior? Because if you pop the hood on the companies of the future, you might not find an engine you even recognize.